Okay, hi everyone. This is going to be the video for the Chapter 5 PowerPoint. Let me get that out of the road. What are we looking at here? Right, well, it's going to be the time value of money, right? Really, what this comes down to is that money makes money, right? If a dollar today is worth more than a dollar tomorrow, right? So that's what we mean when we talk about the time value of money. If I say to you, would you rather have 100 grand today or would you rather have 100 grand in 6 months from now? Well, you'd be better off taking it today outside of like the obvious, like sort of like greed factor. You want it right now. The reason for this is, hey, you could put the 100 grand in the bank or in the stock market such that it would earn interest or grow in value and it would be worth more than 100 grand in 6 months or a year or whatever the case there is. So that's the ideal with it. Money makes money. So this is just saying, hey, if you put $100 in the bank and it yields 6%, the future value of that is going to be $106. And we'll talk about this kind of like time value of money, these present value, future value. First, let's distinguish simple versus compound interest. So the idea with this is interest kind of accounts for that time value of money. If you lend your money, somebody's going to pay you interest. And if it's simple interest, right, it's going to be whatever you lend them times the rate times the period of time. This is in distinction to compound interest, where we have to kind of look at that and calculate the amount of interest that compounds or adds to the underlying basis or amount of debt. So here's an example of simple interest. Hey, we got $1,000. There's a 10% rate 1 year. Hey, the amount of interest is $100. It's simple. It's just that calculation. In distinction, right, if we have compound interest, right, in this case, you invested $1,000 in an investment paying 10%, but it compounds annually. What that really means is, yeah, we can use that equation for year one to calculate the $100. That's great. But then that $100 compounds or adds to the principal such that in year two, we need to use this new compounded basis. Oh, then it's 110. We got to add the 110 to it, carry it over, right? So it's kind of like it compounds or it gets bigger, the underlying principal on there. The effective rate, a few things to be aware of here. So the effective rate is the actual rate that's in play. Some things here to be aware of, right? Assume an annual rate that's based on a year is 12%. Well, if we were to express that semi-annually, right? So semi 2 times, right? 12 divided by 2, we're looking at 6% per period. If it's quarterly, right? 4 quarters in a dollar times 4 there, it's going to be 3% per period. Monthly, right? 12 months in a year, 1%. Right, you could think of it, right? So if you have like 100 grand, right, and there's 12%, right, on a yearly basis, you'll get, $12,000, right? If it was semi-annual, right, you do 100 times 6%, get you 6,000. You do it again because it's semi, 2 times a year, 6%. 6,000. Hey, that gets you to the 12. It's just expressed on a different kind of periodic basis there. We're looking at it semi-annually. And the same principle applies for quarterly and monthly. Right? So with that kind of being said, right, if we look at the effective interest rate, what you're comparing here is kind of the stated rate, right? They're saying 10%, but once we account for the fact that the interest compounds, it might actually be a bigger effective rate, the amount you actually earn, right? So here, when we run the numbers, when it's compounding interest, right, we put $1,000 in, we get 1102 out, right? So we made 102 there divided by 1,000. Effective rate is going to be 10.25, right? So you got to distinguish the stated rate from the effective rate. The effective rate, like we said, it's going to be bigger here because it accounts for the fact that it compounds. It's a bigger principal that's going to produce sort of more income there. All right, an MCQ, right? If we look at this real quick, looks like Jacob Lee invested $600 in a savings account, paying 8% interest that compounds twice a year. What will be his investment balance at the end of the year? Right, so it's 8%, but it's twice a year, right? So it's we got to do 8 divided by 2. That's 4% at a semi-annual rate. So the initial deposit here is $600, right? 4% times 600 is 24 bucks, right? We add that to it, 4% times 624, 25 bucks. We're looking at 649, right? So this is showing an example of compound interest, but as well as kind of layering in there that idea of figuring out the semi-annual rate. It's not always as simple as just using the given stated rate. Sometimes you have to sort of convert it in light of different facts there. All right, let's talk a little bit about the future value of a single amount, right? So you can just think of this like a dollar. Really, what's going on here is we're trying to figure out, and you can think of this like a bank account, right? If you put $100 in your bank account, right, what will it be worth? You know, a single amount, right? It's not a series of payments, it's just a single amount. What will be it worth in the future in 3 years, 5 years, right? That's the idea here. We're taking a present amount and figuring out what it's worth in the future in light of the time value of money, right? Maybe I get X% return in that bank account. So one way you could calculate that is through an equation, right? That's fine. The other way that's you could do it is through the tables, right? The time value of money tables. So here it's saying, hey, we got $1,000. It pays 10% interest rate. It compounds annually. We're looking at the end of 3 years. Essentially, what we do here is we say, oh, okay, it's 3 periods, 10%, right? That's going to get us our factor. We'll take the amount here, the $1,000 we put in times the factor. Hey, in the future, right, it's going to be worth 1331, right? So the idea here with the future value is, right, it kind of looks at the present value, the current amount, times the factor, which is comprised of the I in the end, right? And we will see a very common theme in this chapter is, hey, can you please tell me here the future value? That's what we started with. But then they'll get kind of tricky with it, right? Oh, and they'll play like the shell game, right? Well, we'll give you future value and we'll give you this. Please tell us, what we need to put in that account today. Oh, we'll give you these things. Please tell us the interest rate. Oh, we'll give you these things. Please tell us the number of periods, right? So they start here easy, but essentially what they're doing is a bunch of sort of stretching you out, stretching your mind, seeing how these things work. Right, so there's an MCQ. You can look at that there. The present value is the reverse, right? The present value of a single amount, right? So like of a dollar, which is in distinction to an annuity, right? This is taking an amount in the future, right? And kind of shrinking it down into today's dollars, right? So maybe it's, right? Maybe you want 100 grand, right? Maybe here you are in 9th grade, right? And your parents are like, I need to save and get 100 grand in the bank account to pay for your college by the time you're a senior in 12th grade. How much do I have to put in a single amount in the bank account today, right? So you can think of this one like college, right? Present value of a single amount. So again, you can do it through a formula, right? That's fine. Or we have the tables, right? And the idea here with the tables is, right, here it'll be 3 periods, 10%, right? So it's like we play Battleship kind of, and that's where we get our answer, right? So it'll be the present value equals the future value times the factor, again, the I in the end there. And like I said, they start with this easy, but then they're going to try to trick us up and say, oh, we'll give you everything but the I. We'll give you everything but the N, right? How do you deal with these? Right, so this is just showing you sort of an example here. This is saying, and you can read this, you have to look at the facts and circumstances, right? If they gave you 2 choices, would you rather have 1,000 now or 1,000 3 years from now? Obviously, you'd have the 1,000 now. But if it was 740 now versus 1,000 3 years from now, then you kind of have to run the numbers and see which one makes sense. It might be, and in this case, it's a function of that discount factor there, the rate that's in play. All right, so there's an MCQ. You can look at that. Now they start playing the shell game, right? Determining an unknown interest rate, right? So the I is in play. So they say, suppose your friend asks to borrow $500 today, and they promise to repay you $605 in 2 years from now. What is the annual interest rate that you'd be agreeing to, right? So they're kind of, instead of us solving for the present value, they're giving us all of these, and then they're saying, oh, can you please figure out the I here? How do you do this, right? Well, we have, right, that equation, right? The present value equals the future value times the factor, right, which is the I in the N. All you essentially do is, a little bit of algebra. You move the future value over here, right? 500 divided by, there's 0.82. So we know in this case the N is the 2, right? So we go 2, right? We work our way over until we hit that 0.025. Then we go up and we back into the 10, right? So it's kind of like playing Battleship in reverse, right? Normally it's like 2 and 10, and then you kind of map the coordinates. Here it's like 2, you work your way over and you go up, right? It's just stretching you out, solving for a different variable there. Here, right, they're looking at the number of periods, right? So in this case, right, they're hiding the ball under the N on that, right? So you can look and see, right, they basically just rearrange it. And then there'll be 10%. We go down, we find that, and then, we go that way. There we go, right? Instead of going like this, and then finding our answer, we go this, find our answer, right? So it's just, mixing things up a little bit here. All right, then they talk a little bit about monetary assets and monetary liabilities, right? So monetary assets are basically money and claims to receive money in the future. So you're really talking a lot about receivables here. And then monetary liabilities are obligations to pay in the future. You're really talking about, notes payable here, okay? So when we're valuing a note, right? And this is like sort of like one of the things with this chapter is it feels like we're going into outer space. We're talking about all this time value of money. This does link up to the financial statements, right? Don't worry, there is a method to the madness here. This ultimately does come into play. We use the time value of money concepts to record and do journal entries, right? So here, right, the shoe company manufactures athletic shoes for the sale to retailers. They sold a large order for 50 grand. Right? It looks like they agreed to accept a note in payment of the shoes, requiring payment of 50 grand in 1 year at an interest of 10%, right? So what's going on here is, right, so 10%, 55,000. what is going to be the present value of that, right? So it's really just showing, oh, okay, we're going to hide the shell over here. When it's a note, we'll give you the variables for this. You got to back into it, right? So we got, future value times the rate from it, right? It's 1 and 10%, right? So 1, 10%. We use the formula. Oh, the present value is $50,000. This one they talk about no stated interest rate. So let's compare that with the prior example. Shoe company recently sold a large order of shoes. Terms of the sale require sporting goods to sign a non-interest bearing note of $60,500 due in 2 years. Right. So there's not going to be, in this case, there is no stated interest rate. Now the stated rate, again, there's different rates here. You got the stated rate, you got the effective rate, and you got the market rate, right? We're going to use that market rate for the I there. Here, the stated rate is 0, right? 0%. Why would anybody charge 0% on a sale, right? Well, the idea with this is they build it into the sales price, the interest, right? Say you want to buy a mattress and it's like, one of these fancy Tempur-Pedics, and it's like, we'll charge you $7,000, 0% interest. Really, what they're doing there is, right, normally they would sell it for $5,000 or $6,000, but they're going to instead sell it to you for $7,000 and not charge any interest. So that kind of differential in the price, yeah, even though we don't have 0 interest, we're making it up on a greater sales proceeds, right? We're selling it for a bigger amount. So 0 interest, but we're jacking up the sales price. We're implicitly building that interest into the sales price, right? So again, it's just kind of showing you here how you'd run the numbers on it, right? The $50,000 present value on there. They then have an MCQ. You can look at that on there. And then we move, into annuities. Right, so an annuity is basically a steady stream of payments for an equal amount during a specified period of time. Right, and when you have annuities, right, you can have an ordinary annuity where the payments occur at the end of the period, or you can have an annuity due, right? I always think due now, right, which is the payment is at the beginning of the period. All right, so let's look at an example here of an ordinary annuity, right? We know the payment here is at the end of the period. It says an installment note payable might require the debtor to make 3 equal annual payments with payments due at the end of each year, right? So here's the end of year 1, there would be a payment. Here's the end of year 2, there would be a payment. Here's the end of year 3, there would be a payment. This would be an annuity because it's a steady stream of payments, and it would be an ordinary annuity because the payments occur at the end of the period. In distinction, right, an annuity due now, the payments would be at the beginning of the period. So they give us some MCQs here, right? You can look at these. I'm not going to do these in kind of a summary video, but when we have an annuity, right, whether it's an ordinary annuity or an annuity due, right, we also have that future value and present value concept, right? So, and when you see these, it might be like FVA and PVA. Well, it's because it's like future value of an annuity. What's the idea with these, right? What's like simple ways you can think of this? Well, the future value of an annuity is you can think of it like an IRA account, right? Oh, every year you put $5,000 into your IRA, which is a type of retirement account, right? Year 1, year 2, year 3, year 4. What are each one of these payments, right? When you calculate the future value, what is your account balance? If I came up to you and said, please tell me the value of your IRA after all this time, that would be a representative, like simple way of thinking of a future value of an annuity. The flip side, right, the present value of an annuity, this would be like winning the lottery, right? And what I mean by that is when you win the lottery, right, they may say something like, look, we're going to give you two choices, right? We will give you 100 grand right now, or we'll give you 10 grand for the rest of your life, right? And maybe you're like a little bit older. So the idea with this is you have to compare, right? Is it better to take the 100 grand right now, or you shrink down all of those payments, right, in the lottery, right, what that's worth today? When you compare these two, right, that would tell you if you won the lottery, right, is it better to take the lump sum or the annuity, right? So it's just high level ways of thinking about it. Let's look at it in a specific example here of the future value of an ordinary annuity, right? So they tell us here 10 grand a year, you're going to invest for the next 3 years. There's a 10% annual interest here. They want to know you decide to make the first payment 1 year from today. So here's today, the first payment is at the end of the year, right? Well, if this is at the end of the period, it must be an ordinary annuity. They give us the factors here. We know the annuity amount, right? How do we figure out what is this account worth in the future if you do it, right? Well, one way you could do it, right, is each one of these payments, you could kind of figure out what it's worth in the future, right? So like the first payment, you do it, the second payment, the third payment, and then, add them together, right? You can see it's a 3.31 factor there, and it's worth 33,000. The other kind of easier way would be to use the table, right? And the idea with this is, it's 10%, 3 periods. We're looking at the future value of an annuity for an ordinary annuity. They give us 3.31. So essentially we take the future value of an annuity equals 10K, the annuity amount, each payment, times the factor, which is composed of the I and the N. It's worth 33,000, right? That's like an easier way to do it. And again, they're going to play the shell game here, right? They're starting easy by giving you the other variables and saying, please find the future value of the annuity. Then they're going to say, we'll give you everything else. Please figure out what the annuity payment is. We're going to give you everything else. Please tell us the interest rate. Please tell us the number of periods. So you kind of have to just use some algebra and move this equation around. Right, here's another example, same facts, except it's an annuity due. Right, it's at the beginning of the period. Right, you could do it individually for each payment, or you could use the tables right down here. Right, you can see it's worth 36,000. And the idea with this is, right, the annuity due, the account balance would be 36, but the ordinary annuity, the account balance was 33. Right? Why is that the case? Well, hey, we had additional time here for each one of these investments to grow and get bigger, right? We didn't wait a whole year until we made our first contribution there. Right, so here they give us an example, right? The Fertilizer Corporation wants $8 million for plant expansion, right? It's needed on January 1st, 2029. They intend to make 5 equal annual deposits that will earn 7%. The first deposit is to be made January 1st, 2024. Present and future value factors are as follows. So they're giving you a lot of different information here. You have to analyze this and say, what am I really using, right? What is important here? It's not only enough to be able to use those tables. One way I could shorthand it is give you the information from the tables and have you pick here. So what they're asking for is, what is the required annual deposit? In other words, if you want 8 million in X amount of time, how much do you need to make for each deposit for the 5 years, right? So you'll take the 8 million, you'll then divide that by the 6.15, right? The future value of an annuity due of $1 at 7% for 5 periods. Looks like each payment you better be putting in 1.3 for that. So you have to kind of go through here and figure out which one of these do I use, what's it asking for. This one, right, it says IR Right plans to make quarterly deposits of $200 for 5 years into the savings account. The first payment will be made immediately. The savings account pays an annual rate of 8% compounded quarterly, right, so 4 times. How much will they have accumulated in the savings account at the end of the 5-year period? So essentially, hey, we're putting some money in a bank account. Can you please tell us what this bank account will be worth in the future, right? So we're putting $200 in each payment, but the total number of payments, right, is 20 periods, right? Because it's quarterly, 4 times a year, times 5 years, right? That's where we get the 20. And then the interest rate here, it's 8% compounds quarterly, 2%, right? So that's, you kind of have to convert here. It's not as simple as just using it. Plug that number in. We're looking at 49.57, right? That's the idea with it. Okay, let's talk a little bit about the present value of an ordinary annuity. Right, I said this is like the lottery. Right, they're giving us some information here. Suppose you want to determine the cost of a 3-year graduate program. The cost is $10,000 each year with payments made at the end of the year. What is the cost of the program in today's dollars? Right, so you're trying to shrink all of these future payments down in today. So you could do it individually, each one of the payments, or you could use the table, right? 3 years, 10%, there's our factor, $10,000 payment times the factor. We're looking at 24 grand, right? It's more efficient to do it that way. Similar setup here, it's an annuity due. You can look at that, right? So it's at the beginning of the period. So you just would use the appropriate table for that. They then talk a little bit about the present value of a deferred annuity, right? So they're giving us an example here. Say you want to buy an investment that will provide 3 equal payments of 10 grand, right? So it'll give you 10, 10, 10. However, the first payment you're not going to get until the end of 3 years, right? So we kind of have this little gap here before the payments start kicking in. How do you deal with this, right? How much would you be willing to pay? What's that investment worth in today's dollars? So the easiest thing to do in these situations is you essentially just shrink each one of them down. Shrink that one down, it's worth 7,500. Shrink that down, it's worth 6,800. Shrink that down, it's worth 6,200. The present value today, what you pay for that investment is $20,000, right? So it's basically just saying, you should ignore these guys, right? There's nothing in there to calculate, but what that does mean here is when you present value that, that's after 3 periods, right? It's the first payment, but it's after 3 periods. Here's an alternative way you can do it with the tables. I think this is a little bit more difficult. I think the easier one, and if you were to see this on the exam, wouldn't be any more difficult than that one we just looked at. They have, an MCQ there. Then they start playing the shell game again. Right? They're saying determining the annuity amount, right? So the missing value here is the annuity amount, how much each payment is going to be whenever we give you all the other information, right? So they're just hiding the ball somewhere else. Assume you borrow $700 from a friend and intend to repay that amount in 4 equal annual installments beginning 1 year from today. Your friend wishes to be reimbursed at an 8% rate. What annual required payment must be made to repay the loan in 4 years? So your friend says, look, I give you $700. I want an 8% return on this. Pay me over 4 payments. How much should each payment be to satisfy this criteria, right? So that's where the mystery mark here is. So all we do here, right, is we kind of just rearrange the formula, right? We have, the present value of that annuity equals the factor that we can get from this guy right here times the annuity amount, right? Slide that over, 700 divided by the factor. Oh, each payment, right, it's got to be $211, right? You just rearrange the items on there. Next up, right, another time they're kind of hiding the shell here, determining an unknown number of periods, right? So here's kind of the mystery, right? And they say down here, assume you borrow $700 from a friend and you intend to repay them in equal installments of $100, right? So here it's like $100, right? Every time you pay them, it's $100, right? So you borrow 700, you're going to just keep paying them $100. They want a 7% rate of return. How long is this going to take if we're paying them $100 at a time, right? So really all you do here, right, it's going to be that present value equals the annuity amount, $100, times, the factor from there. So we'll slide that guy over, 700 divided by 100 equals 7. Right, we then can use the chart, right? It's like reverse battleship. We can back into the N, right? The N there will be 10 years, right? So it's kind of like what we looked at before. Here, right, with an annuity, right, determining the interest, right? Suppose a friend asks to borrow $331 today, right? And they promise to repay you $100 over the next 4 years. What interest rate are you getting on this, right? If your friend comes up to you and is like, look, lend me $330, I'll pay you $100 over the next 4 years. You're trying to figure out, well, what's my return on this going to be, right? So again, we have the present value divided by the annuity amount, each payment, $100. There's the factor, 3.31. We know the N is 4 because it's 4 years. We play reverse battleship when we use the chart. Oh, if I'm getting and lending you $330, I'm getting $100 a year for the next 4 years. I'm effectively getting an 8% return on that. This one, it talks a little bit about unequal cash flows, right? You can see it's like 100, 100, 200. So it's, this is not equal to those other ones. Don't worry about that, for the exam. That's like a little bit more advanced item there. They then have some MCQs here you can look at, and then they look and they say, okay, how does this tie up? How does this relate to financial accounting, right? We looked at it a little bit with notes, how you would consider that present value there. You also would do it with bonds, right? So I know everybody loves bonds, right? It's like the favorite part of financial accounting. But if you think about a bond, right, So if you're a company, right, a corporation, there's two ways you can raise money: debt or equity. Right, equity is like you're letting people be shareholders. Debt is really like you're borrowing the money, right? It's like you guys going to school, you're going into debt, you're borrowing student loans. So in this way, right, say we're a corporation and we sell a bond, right? Say it's like, a $10,000 bond. That's great. Essentially what we do is we'll say, look, you can buy our bond, we'll pay you some interest, and then we'll give you your 10 grand back at the end, right? So maybe we'll give you like $1,000, $1,000, $1,000, $1,000. Whenever we do, right, we record this bond from the corporation's point of view, we got to present value all these interest payments, right? That fact, right? That's going to be the present value of an annuity. Likewise, we got to present value that lump sum, right? The 10 grand at the end, right? That's going to be the present value of a single amount or a dollar, right? And why would anybody invest in our bond, right? Well, somebody would buy it because they're putting 10K in, they're going to get it back, as well as, they'll get 4K interest, right? So you put 10 in, you get 14 out, you just made 4 grand, right? So this is showing you that, oh, okay, you would present value the annuity, you would present value the lump sum, right? That would be the price of the bond. And then you would use that price to help you calculate interest, right? It gets a little bit tricky there. Like, how much do you go into bonds here versus like, considering the time value money. Just be aware of this like high level setup on it. Likewise, long-term leases, we're going to use this time value of money, right? So say we sign a 25-year lease for an office building, right? It's going to be annual lease payments of 10 grand, right? So we're going to pay 10 grand for 25 years. There is a 10% rate of return here. How do we value this, right? Well, the lease is going to be a right of use asset, right? And essentially with it, right, we're going to treat it like an annuity, right? We got all those payments on it, right? We're going to shrink those down, 25 years, 10%. Oh, 99,000, right? Debit, right of use asset, 99,000. Credit, lease payable, 99,000. Right, there's an MCQ you can look at, right? They talk a little bit about the valuation of installment notes. Right, so if we look at this kind of quickly just to get through here because we're running out of time. I don't like these being more than like 45 minutes. It says on January 1st, the shoe company purchased $35,000 machine. It had, right, so they paid 35 grand. That's the sales price. It was $5,000 down and then a 5-year installment note for the remaining 30. Terms of the note call for annual installment payments at the beginning, with the first payment due on January 1st and at each December 31st thereafter, assuming an interest rate of 4%. What is the amount of the annual installment payments? So then it says the annual installment payment amount would pay a $30,000 loan, right? This guy right here, at a 4% interest rate over 5 years. How do we do this? Right, so it's the number of periods, right? 5 years, 4% interest rate, right? That $30,000, right? We're looking at 6480 for the annual installment payment, right? We're kind of looking there at, we're just using the annuity stuff to see, hey, how much is each payment? 6480, 6480, 6480. Right, so when we buy it, right, you do debit machine, credit cash, credit note payable, right? That's great. And then as they record the first installment payment, right, they'll kind of knock this note payable down by the 6480, right? And then they'll pay cash for it, right? So it's like you tee it up at the gross, you knock it down based off of how we calculated it over here. Then they have interest expense, right? So they talk about no interest is needed for the first payment, but potentially later on there would be interest expense, which is the difference between like the cash interest that's paid and the amount you calculate. So it gets a little bit tricky there. And then they talk about, hey, we use this time value of money for pension obligations as well, right? So it says, and one of the things is like pensions, like these are like, a thing of the past. Not many people have them, but they still love to account for them. You'll see them, like in your more advanced financial accounting class. But the idea with a pension is it's kind of like an annuity, right? You get paid a certain amount for a certain period of time, right? So a company hires a manager. They expect that manager to work 25 years before they retire. And then their pension is, right, they get a payment after they retire for a fixed period of time. And it says here, the company, right, so you're the company here, we have this guy who works 25 years. We expect to pay him after he retires 20 years, right? So the idea here is we're going to estimate it to be $2,000 per year that we're going to have to pay him given the terms and conditions. The company plans to contribute cash to a pension fund that will accumulate to an amount sufficient to pay this benefit. Assume the company anticipates a 6% returns on all funds invested in the pension plans. How much would the company have to contribute at the end of 2024 to pay for the pension benefit? So it's almost like, hey, we know in the future we need to pay X to this individual, $2,000 per year for 20 years. How much, right, do we need to kind of set aside now such that at a later point in time we'll have enough money to kind of tackle this, right? So the idea with this is you have a deferred annuity, right? It's deferred because we kind of have this like sort of like fill in the blank space there before it kicks in. Then once it kicks in, right, we're paying him $2,000 a year for 20 years. We basically just use the annuity stuff here, right? It's $2,000 a year times the factor there, right? 20 years, 6% rate of return, right? You're looking at 22,940, right? That's the present value of an annuity there. And then the present value here, the 22,940, the future amount times the present value of a single amount, right? How much are we going to put in today, right? With 24 periods, right? And a 6%, right? So there's N 24, 6%. We're looking at 5666. A little bit wonky, a little bit convoluted if you think about it, right? It's a deferred annuity. We're trying to figure out, what we got to put in there, right? The other thing to be aware of is that you can use Excel to do this, right? You could hypothetically, and many people do in the real world, just use a formula in Excel to calculate the future value. You could do this on the homework if you wanted, that's fine. The problem is on the exam, you need to know how to do it with the numbers. You need to be able to use the tables. You're not going to be able to use Excel. So it's great, right? You can use Excel to try it out and see it, but that's not how they test it on the CPA exam. They then kind of give some examples here, a summary of future value, right? Future value of $1, an annuity, right? Ordinary, due now, present value of $1, present value of an annuity, ordinary annuity, present value of an ordinary or of an annuity due now. They then talk about, right, some of that like conversion, right, for the N and the I whenever you have compounding periods, right? So if it's 7%, right, annually, it would be 7%, but if it was semi-annual, it would be 3.5%, right? We got to divide it by 2. Quarterly, monthly, right? You do a similar thing. The problem becomes, right, what it says here, we could use table 1 for annual and semi-annual. You're not going to be able to use it like the time value money tables for those latter because when you calculate it there, the 1.75% and that, right? The tables, the time value money tables, they don't have every single factor on there. They're within reason and usually like at some interval, right? It's like 1.5, 2, 2.5, 3. They don't get like this like really kind of granular there with it. So do be aware, right? Yeah, maybe you got to convert like the I or the N. Not that hard. But sometimes the table, if you get like too specific or too sort of wonky there, you won't be able to use the table because it doesn't account for every single variation or possibility that you could have. All right, so with that, I'm going to end the lecture here on the PowerPoint for Chapter 5.